Hey, what's up guys? Welcome back to the channel. Welcome back to another video. Today we're going to be talking about cash flow. Specifically, how do I use a cash flow analysis to assist me in determining if I want to purchase a particular property. Now, I'm going to be using some notes today because I got a lot of numbers and I don't want to mess up anything. So guys, bear with me with the notes. Now, there are three pieces of information that I'm going to need in order to do a cash flow analysis on any particular property. The rental income for the property. I'm going to also need to know what the operating expenses are for the property. And then I'm also going to need to know what my loan payment will be for that particular piece of property. So on this particular property, it's a $216,000 single family home. It is a 3-bedroom, 2-bath. It has 1,950 square feet. Now, let's start with the rental income. There are two sites that I use in order to help me kind of get an estimate of what I can expect from a monthly rental income for any particular property. One of them is called Zillow.com, Zillow.com, and the other is Rentometer, Rentometer.com. So you basically put in the address of the property, and within a 1-mile radius, it will tell you what the estimated monthly rental income is for the property. Now, for this $216,000 property, the estimated monthly rental income is $1,740. Now, when we annualize that, that's $20,880 in annual rental income on this particular property. So now let's move on to operating expenses for the property. Now, how do I determine prior to purchasing the property what the operating expenses will be? Well, what I typically do is I will take 30% of the annual rental income or projected rental income for the property. So now, if it was a property that I already own or one that I'm already under contract on and I wanted to really dig in and find out exactly what these expenses are, then what I would do is I would go to, in the area I live in Florida, we can go to what we call the property appraiser's website. Each county has one. And on that property appraiser's website, it will give you historical information on property taxes paid. So I can easily go back to 2018, put this property address in, and it will give me exactly what the property taxes were for that particular property. And again, in the state of Florida, we have property taxes. Every year, property that you own, you pay a tax on it. I'm not sure if every state has that, but in Florida we do. If I wanted to know what the insurance was, I would simply pick up the phone, call my insurance agent, give them the address, and they would give me an estimate of what my insurance cost would be for that particular property. Also, for repair and maintenance, I would simply ballpark that. Normally what I do on my properties is I allot $1,000 a year for normal routine repair and maintenance. Now, I'm not talking about capital expenditures like a new roof or a new air conditioning unit. I'm not talking about those types of expenses. We'll get to those later. I'm just talking about your normal, everyday leaky faucet, garbage disposal is broken, refrigerator may need a small repair, those type of repair and maintenance costs. And then the last one that I look at as it relates to expenses is homeowner association fees. At least in the state of Florida, if you live in a gated community, you're going to be assessed a homeowners association fee most times on a quarterly basis. Sometimes monthly, but mostly on a quarterly basis. So I have to add that into my expenses. Now, when I do my 30% on this particular property, that would give me an amount of $6,264. So now I know what my projected rental income is, which is, let's write that down. That's $20,880 projected rental income. I also know what my expenses are. That's going to be $6,264. So that's expenses. Now the last one is going to be loan payment. Now on all of my properties, guys, I get loans. So I have to also figure out what my estimated loan payment is going to be as I do my due diligence on this property before I sign a contract to purchase it. Now the way I do that is I go out to the internet and I normally pull up a mortgage calculator. And in that mortgage calculator, I'll go ahead and put in what I expect I'm going to do as it relates to my financing terms. So I put in a 30-year fixed mortgage. I put in 20% down. The house is worth $216,000. That's the purchase price. So if I put 20% down of that, that's going to be $43,300 down payment, which will leave me with $172,700 mortgage balance. So then I'll put an interest rate on that, which I did 4.15% on 30 years. And that gives me a principal and interest payment of $839. So let's write that down. And if we annualize that, it's going to be $10,068. And that's loan payment. So I'll just say LP for that, loan payment. So now I know what my potential expenses, I know what my potential rental income is going to be. That's that number. I know what my potential operating expenses are going to be. That's that number. And now I also know what my potential loan payment annualized would be, which is that number right there. Now, once I know all three of these, then basically what I want to do for my cash flow analysis, I want to simply take my annualized rental income, my projected rental income on an annual basis. I want to take my expenses on an annual basis, and I basically want to subtract out that, right? So when I do the math, now we're going to get to the loan payment here in a second, but let's do the math on the rent minus out the expenses, and that's going to be roughly, let's put that number right here. That's going to be roughly $14,616. That's what's going to be left. Once I take the $20,880 minus out the $6,264, that's going to give me $14,616. Okay. Now what that is right there, that's going to be my, what we call net operating income, which is simply rental income minus operating expenses gives you net operating income. So I'm just going to put NOI right here. NOI. All right? So we have that. Now the next thing we want to do in order to finish our cash flow analysis is we want to go ahead now and we're going to have to subtract out our loan expense. So let's take this 10,000. I'm going to take the 10,000 and move it here. We're going to go 10,068. Now what is that? We're going to have a net left over of $4,548. Okay? That's what we got left. And guess what, guys? That's our cash flow right there. So our cash flow on this property is expected to be $4,548. Now let's take that cash flow. Let me just put that right here. We want to say cash flow. So we have a pretty good positive cash flow on this property. But let's take it one step further. I want to also know what my cash on cash return is. So the way I would calculate that is I would need to first have my out-of-pocket cost that I'm going to be putting into this property. My out-of-pocket costs are, remember we talked about that 20% down payment, $43,300. Let's put that over here on the side. So we got $43,300. That's down payment. Now what we want to do is we want to divide 4548. No, before we do that, we also got to include in our closing costs. So let's just say that's going to be $4,600. So we want to add that up, and that's going to give us 00974. So let's just round that off to $48,000. So our total investment, and when I say cash investment, that means your down payment and your closing costs. In this particular scenario, that's $48,000 for me, right? Now I already know my cash flow on an annual basis on this property is projected to be $4,548. Now the way I would do that is I would simply do the math on this. I would take the 48, and I would just simply divide that by the 48,000. And that would give me a cash on cash return of 9.5%. I'm putting 48 grand in this property and I'm going to get a 10% return. Plus, I know history tells me with real estate, at least single family homes, every year it's going to appreciate in value as well, to the tune of 3 to 5% a year. As long as the economy is good, things are doing well, it's going to appreciate 3 to 5% each year as well. So if it does 3% a year, do the math on that, that's pretty good. 216,000 at 3% a year, you're probably in that 7 to 8 grand range a year. 7 grand a year in appreciation. If you get the 5%, then you're going to be around $10,000 a year in appreciation, not depreciation, in appreciation. So you can see your cash on cash, my cash on cash return on this property is going to be about 10%. Plus I'm going to get another 3 to 5% in appreciation every year. But let's just recap real quick. So we need to know rental income. We need to know expenses. And then if you're going to have a loan, you're going to need to know what your loan payment is on an annualized basis as well. When you get all of those things, then you're in a position to run your cash flow analysis. And in this particular case, our cash flow is positive. 4548 positive cash flow. 10% return on cash investment. I get a 10% return basically. I'm happy with that. I would move forward with this property based on this information right here. I would certainly go under contract. Now, when I go under contract, I'm going to have some things in the contract that still give me some wiggle room just in case something goes wrong, I can get out of the deal. I'm going to have a financing contingency in my real estate contract. So if I can't get financing, I get to walk away from the contract and not lose my security deposit or my deposit. Also, I'm going to have in that contract is a inspection period. So remember we were talking about those capital expenditures, and I told you we'll get to those later. That's where you're going to uncover your capital expenditures, and you're going to know if you got a bad roof or you got a bad AC, air conditioning unit, or you got bad electrical or plumbing in the house, you're going to find those things out through your inspection. You're going to have a homeowner's inspection done. And if those things pop up, then that's an opportunity for you and the seller to negotiate a little bit more, and you get money off, or the seller will fix those things. Now, if you buy the house and then a year from now or 2 years from now you need a new roof, then that cash flow of 45, 48, what I recommend you do is you put some of that cash flow aside and build yourself a reserve fund, so that when it's time to pay for capital expenditures, you have a reserve fund on the side ready to go, and you don't have to dig into your own pocket to take money out. So guys, that's it. That's cash flow. That's the process I go through on every property that I take a look at. And I gotta say, it's been very helpful for me to do that. In most cases, when I perform this cash flow analysis, I know right away whether it's a property I want to pursue or not. So, all right, guys. Hey, thank you for taking some time out with me today and going through this quick cash flow analysis with me. If you have comments, drop them in the comment box. If you want to get some more in-depth questions answered, you certainly can DM me on Instagram at RichardFain28, and I'll be more than happy to try to answer the questions that you may have. If the information was helpful, please give me a thumbs up. If you're stopping by the channel for the first time, please consider subscribing and share the video. But guys, until the next time, y'all keep chasing greatness. Peace.